what we saw in fixed interest in short was that there was a massive sell-off. There was basically a massive sell-off in anything that was tradable around the end of March. People either realised their bonds because they needed cash, call them Host Plus. They got out of their positions and they ran for the doors. We saw currencies did not, the US dollar strengthened as people moved to US bonds, but other currencies fell. Corporate bonds and emerging market debt underperformed government bonds as people who needed to be in bonds went for safety, and the performance of corporate bonds, its poor performance was exacerbated by a lack of liquidity. That changed, and if you were on the last call, we said that credit markets were going to open up and there were going to be significant spreads, significant opportunities, and so we put money into those opportunities during after the end of the quarter. Anyway, I'll keep going with this dot point. The differential between borrowing and lending rates, known as the credit spreads, expanded by 1,000 basis points, 10%. And so, Sharif, you take me to the next. So what you'll see with clients who are in MDA strategic fixed interest is they suffered a capital loss at the end of March, and now they're getting significant income. And if they had cash available, we put more money into those markets. And we put more money in because if you have a look at this chart, right there at the end of March, we're out at 1,100. And then it comes back, and we started getting in around about the 800. And you'll see that it's coming back. And the reason it came back, the reason it went out so steeply is people fled for the doors. You've got market illiquidity. We're all going to die, panic, death, destruction. And then the chairman of the US Fed strode to the lectern and he said, whatever it takes. And the US Fed and indeed the Reserve Bank entered the credit markets and the debt markets, and they started transacting, buying and selling bonds and helping issuance happen. And we've seen companies issue significant amounts of debt, and we're seeing credit spreads come back. And how long, you might say? So a client says to you, oh, well, I've suffered a loss here in strategic fixed interest or other debt markets. What we saw in the GFC is it took debt markets about 18 months to sort of claw their capital back. And there was some really good income in that period. So there's every reason to expect that will continue this time. So if we move on to the next slide, we topped up our positions in Ardea Real Income. So those of you who are not across that fund should read up on it, but effectively they're buying government securities and playing the yield, playing the curve, the derivatives curve. So when people at Hester, Host Plus, Rest were running for the doors, they were saying, "Thanks very much. I'll buy you up for cents in the dollar." So they should have a good performance. This is volatility. Volatility is their friend. And the guys over at Bentham, it's as good as it gets for them. The credit impairment is not a significant issue, albeit they need to be alive and alert. For those who study US debt markets, you'll know that in last year, Hertz Rent-A-Car had a credit rating the same as the US government. Hertz Rent-A-Car is currently in Chapter 11 bankruptcy. Maybe the US government will be there as well. But no, in all seriousness, that's what we're paying these guys to do at Bentham, and their whole team is to really look at that sort of stuff. But the opportunities on credit spreads is huge.